Standard Bank, Absa, FNB, the commercial banks of South Africa are going to be the cheapest form of finance that you can use to build your property portfolio. The only problem is that they are quite restrictive in terms of their terms. The bank will mostly look at your affordability and your credit score, and if those are not in shape, it's very hard to get favorable terms. In this educational, I'm going to take you through what those terms are that the banks look at and how you can position yourself to be seen as a low-risk candidate to receive the best terms from the bank.
I educate people to reach financial freedom through property through cash flow positive investments, specializing in the low-income multi-let residential market.
So bank finance is cheap and widely accessible. If you've got a good job and you've got a good credit score, you can walk into any one of the big banks with a good property investment and they are likely to give you favorable terms. The problem with bank finance is it is very restrictive. There's not a lot of negotiation room. You can't go to Absa or Standard Bank or any of these big boys and say, you know what, I've got a job 9 months of the year. The other 3 months of the year, I'm not really employed, but you know what, I can hustle up some money to do that. The bank's not going to look at that and be like, okay, we'll negotiate on your terms. They've set out their parameters and you must play within those parameters. So those parameters that the bank are looking at is all to do with risk. They will look at you as a candidate or your company or your trust or whatever it is, the vehicle that you're using to invest with, and they're going to allocate a risk item to it. And they're going to say, this person, Ashwin, how risky is he? They're going to investigate you, and then based on that investigation, they're going to determine what LTV, what loan to value percentage they will give you, and at what interest rate. So these terms that the bank will define, the loan to value and interest rate, is based on these 4 elements. So your credit score, right? How likely are you to pay your debt? This I took from Uber. This shows the different weightings. So if you've got a 670 plus score, that means you've got an excellent credit history. The bank's going to see you as a very low risk candidate. And then you've got your good, average, below average, and then very poor. If you've got a very poor credit score and you go to the banks, firstly, they probably won't lend to you, or if they lend to you, they'll lend to you at a very high interest rate at a low loan to value because they have to mitigate their risk. Secondly, the banks will look at affordability. How big is your salary and how much can you afford to lend? This is probably the biggest restriction because if you're self-employed or if you don't have a steady income stream, you're a commission earner, that kind of thing, the banks tend to expect you to go through a lot of hoops. You'll have to give 6 to 12 months bank statements. You'll have to prove that you can afford this deal. As you build a company and that company becomes valuable enough, the bank will start to look at the company to hold surety and not just you as the individual. And then the property type, are you buying a house, a flat? Are you buying commercial, industrial? Those do attract different terms, and then the investment vehicle. So the first thing that I'd recommend that you do is go and check out your credit score. I use a company called clearscore.com, 100% free, and they give you a metric to say this is a bad, poor, good, or excellent credit score that you have. And then they'll give you some action items to say this is what you should be focusing on to improve your credit score. The higher your credit score, the lower your risk to the bank, the more favorable your terms. So it's really, really important that you go and research this. Another thing that you might not know about credit scores is that they have replaced your blacklisting. So in the past, people were blacklisted by companies or creditors when they didn't pay, when they defaulted on their payments. Nowadays, there's not really a blacklisting system, but rather a good and a bad credit rating. So the better your credit rating, the more favorable your terms, the lower or the worse your credit rating, the more high risk you are to the banks. The second thing is go look at your affordability. All right, you can use property24.com/calculator/affordability. You put in your gross income, your monthly income, your net income, your expenses, and we'll tell you what your bond application would be. So using these examples of 28,000 in gross monthly income with 0 expenses, I would qualify for roughly R1 million loan. Really important that you go and do this, especially if you're looking at your first or second property purchase. See what you can play with, right? If you've only got affordability for $500,000 and you don't have private finance or other ways to raise finance, then you can't really go for a property that is R1 million or more. Then your market for where you can purchase is sub 500. Let's look at a comparison. Here we've got 2 candidates. On the left, we've got my man Ashwin, and on the right, we've got Jonah. Now, let's just assume that Ashwin has a very good credit score, 650. He earns a decent, steady salary of 30,000 per month. He wants to buy a residential property in his personal name. Okay. We've got then Jonah on the other hand. Okay, she's got a lower credit score. She's still a sort of an intern student, so she's not earning as big a salary as Ashwin with 10,000 per month. She wants to jump straight into a commercial property purchase, and she wants to buy it through her company. Now, the bank is going to look at these two applicants very differently. Okay, as applicant one, Ashwin, they're probably going to give him 100% loan to value, depending obviously on the purchase of the size of the purchase. It has to obviously fit within his affordability. But because he's got such a good credit score and probably a good enough salary to afford it, they're going to give him a competitive interest rate. So something like prime minus, maybe not 7.5. Prime currently today is sitting at 9.75. So it's not likely that he's going to get prime minus 2.5. And his period will be over 20 years because he's going home loan. Applicant number two, Jonah, okay? She's a higher risk candidate. She's got lower income. She's got a worse credit score. And because she's buying commercial through a company, she's going to get a lower LTV. She's probably not even going to get 80%, right? Most commercial banks or most commercial loans are at a max of 70% loan to value. Her interest rate is going to be much higher than applicant one. And her period will probably not be 20 years. It'll be 10 years. She's not going to get the 20-year loan term like applicant one is going to get. She's going to get a worse term. Why? Because she's going for commercial. So the banks will favor applicant one. They'll give him a better loan to value, a better interest rate, and a longer period to pay it off because he meets the criteria of the bank more. Now, this comes to the point that doesn't really seem that fair. The more you earn, the more you can lend. Ashwin, he's earning more. He's got a better credit score, so the bank is going to favorably look at him and lend him more money than Jonah. That doesn't seem fair, but the reason is because the bank allocate less risk to someone in Ashwin's position than somebody in Jonah's position. Guys, this is really important to understand because the bank is going to be your easiest, cheapest, and most widely accessible finance, especially in the beginning. It's not easy to get private finance for your first, second, third deal because you've got no credibility, you've got no trust. It's very hard to do creative finance deals like back-to-backs, rent-to-rent, where you need very little capital because you need experience. So your starting 2, 3, 4 deals is most likely going to require you to go via the bank finance route. So the better you can make your proposal to the bank, the more attractive you can make yourself seem to the bank, the easier it's going to be to get your finance. Now, if you are looking at the bank finance approach, you're also going to go through a bit more of the bureaucratic transfer process, the conveyancing steps 1 through to 11. When you are going through the bank finance, you're going to go through these steps. Step number 1, you're going to start with an offer to purchase. You sign an agreement between you and the seller that dictates the terms. You then send the OTP to the bank. The bank will then approve the bond in principle. They'll look at your affordability and your credit score, etc. They'll make sure that you can finance the deal. Then the attorneys are instructed to proceed with the sale. The attorneys will contact each other. So your transferring attorney will contact your bond attorney. Your bond attorney will contact the cancellation attorney. And then once those previous bonds that the seller had has been cancelled, the bond attorney will then get clearance to the transferring attorney. The transferring attorney will then get the signed documents to proceed. So once the cancellation attorney has contacted the bond attorney, the seller and the buyer will sign their transfer documents. The payments will then be made in terms of paying the transferring attorney amounts, as well as rates and clearance certificates will be provided. Guarantees will be then provided from the bond attorney. Consent from the bondholder will be the next step. Then the cancellation attorney cancels the existing bond. examination is happened. That's where the deeds office will then just examine all the documents to make sure that everything is done. And that's when we go into registration. Once you hit registration, it's a couple of days, sometimes a week or two, and then the property is lodged. And that's officially when the property is then put into the new buyer's name. Now, this procedure can take on average 6 to 8 weeks. COVID definitely slowed things down a lot because things just built up at the deeds office. So if you're working out on a 6 to 8 week process, that's pretty average. It also depends on the cancellation attorney and how much debt has been assigned. I've had to go through a recent transfer that took 12 months because what was outstanding on the debts of the property was less than what we had offered. So the cancellation attorney wasn't able to cancel the bond until the seller had acknowledged and accepted that debt that was outstanding. But yeah, 6 to 8 weeks. I usually work on 3 to 4 months. I'm a little bit more conservative. So in summary, debt helps you grow your income and thus grow your affordability. So the greater your affordability, the more debt you can access. So it's a self-fulfilling prophecy. If you are comfortable with debt, the more debt you can use to grow your income, the more you can then use that enhanced affordability to get an even bigger amount of debt, right? Property is a debt business, and bank finance, although it's restricted by terms, is going to be your cheapest and most widely accessible type of funding. So in summary, bank finance is probably where you're going to start your property business and where you're also going to be able to scale your business. Make sure that you've got a good credit score by using tools like clearscore.com. Go check out your affordability, find ways to increase your income. That's why I like the cash flow positive strategy, because that's just adding to my affordability. And show the bank that you are a low risk person to lend to so that you can get the best terms possible.
I hope you enjoyed this video. Don't forget to subscribe. Also, please go and check out my books. They're available here or at any exclusive books nationwide.